segment. Joining me right now in a Fox Business exclusive is the president of the Minneapolis Federal Reserve Bank, President and CEO, Neel Kashkari. And it is great to see you, Neel. Thanks so much for being here.
Thanks for having me, Maria.
So I guess that's the first question, right? What about the move in interest rates? You're surprised that interest rates have been going down.
I am surprised that the yield curve has started to invert by some dimensions. I'm also surprised that long-term yields have come down. It's a little hard to disentangle this because a little bit markets are trying to guess what the Fed is thinking, and we put out a fairly dovish statement in the last meeting. So part of it may be the markets responding to the Fed, and then we have to look at what the markets are thinking. And so you have to try to disentangle this a little bit and look for the real economic signals. There's been some evidence that the economy is slowing. I'm not yet sure, is this just a blip or is this a real slowdown? That's why I think our current posture of pausing to get more data makes a lot of sense.
You're not so sure if things are slowing.
I'm not sure. I mean, right now, while we had a weak job report in the last job report, a very weak job report, it was on the back of two very strong reports. I think it's still around 180,000 jobs a month, a 3-month average. And so let's see what the next job report looks like. Let's see what we know Q1 is slow. Let's see what Q2 looks like. I think we need a lot more data before we can conclude that the economy is really slowing.
What you're saying is really important right now. And I want to just talk about that and dig a little deeper into it, because we are seeing really good signals in the U.S. I know Europe is a little bit of a mess. They were lucky to get 1% growth in the Eurozone this year. China has been slowing. But what are the metrics you're looking at in the U.S. to see if that is hitting this country?
Well, job market is number one, as I mentioned. We're going to get another job report coming up soon, and then that'll be important to see if it's a bounce back. Looking at wage growth, I think, is also important. Looking at overall GDP growth, looking at investment, looking at spending. Consumer spending is still 70% or so of the U.S. economy. Is the U.S. consumer remaining strong? They should be remaining strong because we are seeing wages slowly climb. So that means households have more money to spend. Those are the key data points that I'm going to be focused on.
And you tweeted about the labor market last week, and wage growth. Here's what you said. You said, until we see wage growth, net of productivity pick up and signal future inflation above 2%, I will continue to see slack in the labor market. If inflation is close to or below target and there is still slack, no need to tap the brakes.
Correct. So I've been saying this for the last few years, which is we keep being surprised by how many more Americans are out there who want to work, who are not captured by the unemployment rate. And that's wonderful. The more people we can bring in off the sidelines, better for them, better for our economy. So we need to let that continue. That's why I've been opposed to our rate hikes thus far. I want to see more Americans come in and really get convinced that we're at full employment.
All right, so explain to me what happened with the Federal Reserve's pivot. Last year, we were talking about rates moving higher. The Fed has obviously signaled to us that that's not happening, probably no rate hike this year. What happened with the pivot? Can you explain that?
Well, I'll say for me, there was no pivot. My view has been there's more slack in the labor market. There's no need to raise rates. So I think I've seen things consistently.
You've been that voice consistent on the Fed.
I think there's been some of my colleagues have looked at it and said the balance of risks has shifted somewhat. And so now we do see China, as you mentioned. We do see slowdown in Europe. We are seeing some weakness in U.S. economic data. So I think for my colleagues, they're saying the balance of risks have shifted. Let's take this time to pause. And I certainly support pausing right now until we can get more data.
What do you say to Steve Moore, who says cut rates now?
Well, I don't think it'd be healthy for us to be chasing the markets. I think if we are just overreacting to market moves, whether it's the bond market or the stock market, I think that that's not going to do anybody any good. That's going to add to uncertainty and add to volatility. That's why I think we need to get more data to see what's really happening before we make any policy shifts.
So, Neel, how should we be reading then the yield? I mean, you've got the 10-year yield dropping below 2.4%, and we know that that has sort of predicated several recessions in the past. And people say, look, if you have an inverted yield curve when short-term rates are higher than long-term rates, that indicates a recession is on the horizon.
I take that signal very seriously, and I've written about this, and I'm concerned about it as well. But we have to look at why yields are falling. So I think one interpretation is long-run yields are falling because investors are forecasting slower growth in the future. They're certainly not forecasting inflation to take off. A big question mark that we wrestle with is what interest rate represents neutral, that neither stimulates nor restrains the economy. And while I don't take the yield curve signals, as gospel, that it's perfect, I do think it's giving us feedback on where neutral is. Although I was opposed to the rate increases, I didn't think we had moved to a contractionary stance. But we might have. And so I'm looking at the yield curve for giving us feedback on where neutral is. Have we gone above neutral? I still don't think we have, but it's certainly possible. And I don't think we should be in a contractionary stance.
Is there any reason to believe, based on what you've seen so far, that a recession could happen in 2020?
I mean, it's certainly possible. We don't know for sure. There's always a possibility that there would be a recession a year from now or 18 months from now. I think the economists call it the unconditional probability. On any given year, there's about a 15% chance that the next year there would be a recession. I think those recession odds are elevated right now based on these signals from the yield curve, but it's not my base case. My base case is still continued economic growth, continuing the expansion, just slower growth than we saw in 2018.
Continuing economic growth in 19 and 20?
Yes.
Okay.
That's my base case.